Okay, here's the deal. Accounting is a language of business, and debits and credits are the words of that language. But you don't learn debits and credits by reading about or talking about debits and credits. You learn debits and credits by doing debits and credits. So let's walk through the example in Chapter 2 and 3 of your book. C.R. Bird invests $10,000 cash in a new advertising company called Pioneer Advertising. So from the company's point of view, its asset cash is going up and its owner's equity account, called owner's capital, increases. So cash is an asset. Assets increase with debits. Owner's capital is an equity account and it increases with credits. This is easy to remember because cash is on the left-hand side of the balance sheet with all the other assets, so it makes sense it would increase with the left-hand entry. It's easy to remember that owner's equity and all liability accounts as well increase with credits because they're on the right-hand side. Remember, debit means left and credit means right. That's all there is to it. And so we be sure to debit and credit specific accounts. We don't tell stories. We use the memo line to tell our story. Debit cash for $10,000, credit owner's capital for $10,000, and make our little note down here that Mr. Bird funded Pioneer Advertising. On October 1st, Pioneer purchases office equipment costing $5,000, signing a 3-month 12% note. On the day we borrow the money, we don't owe any interest, so we'll worry about that later. Office equipment is an asset. Assets increase with debits. So we're going to debit the account office equipment. Notes payable is a liability account. Liability accounts increase with credits. And again, this is easy to remember. Office equipment is an asset. Assets are on the left-hand side of the balance sheet. So it reminds us that assets increase with debits. Notes payable are on the right-hand side of the balance sheet. So they must increase with credits. So we debit office equipment for $5,000, credit notes payable, and again, we tell our story down here in the memo section. We don't tell stories up in the debits and credits. We just use account titles up here. On October 2nd, Pioneer receives $1,200 cash advance from a client for work we're going to do later. Since cash is an asset, we have to increase it with the debit, but because we haven't earned this money yet, we're going to credit a liability account called unearned service revenue. Unearned means that it's a liability account, so it makes sense it would increase with credits. We make our little note down here so we know which client it was to keep track of who has paid us in advance. On October 3rd, Pioneer pays office rent for October in cash. Expense or debits, expense or debits, expense or debits. So we're going to debit office rent or rent expense for $900, and we're going to credit cash for $900. Expense or debits, expense or debits, expense or debits. So we debit rent expense. Cash is an asset, which means it increases with debits and decreases with credits. And we tell our little story down here in the memo line. On October 4th, Pioneer pays $600 for a 1-year insurance policy that's going to expire on September 30th. When we pay things in advance, whether it's insurance or rent, that's an asset. We're going to use it up over time. Assets increase with debits, so we're going to debit prepaid insurance for $600. And how are we paying for it? Cash. So assets increase with debits, and cash decreases with credits because it's also an asset. In a very similar transaction, we buy 3 months of advertising materials on account for $2,500. So this is those supplies that we're putting into our supply closet. Those are an asset that we're going to use up over time. Assets increase with debits, so we're going to debit supplies. This is an asset account here for $2,500. When we pay people later, that's called an accounts payable. Since we didn't sign a note, it's not a note payable, it's an account payable. Supplies increase with debits. Liability accounts, any account that has the word payable in it is a liability, increases with credits. On October 9th, we hire 4 new employees. We're going to pay them later, so we have nothing to record right now. On October 20th, the owner withdraws $500 cash. Remember that drawing accounts look like expenses, but they aren't. In other words, they are also recorded as debits. So what we're going to do is we're going to debit the owner's drawing account for $500 and credit cash. Cash is an asset. Assets increase with debits, so they decrease with credits. We make our little memo note down here. On October 26th, we owe our employees $4,000 in salaries and wages, and we pay them in cash. Expense or debits, expense or debits, expense or debits. So we're going to debit salaries and wage expense for the $4,000 and credit cash for $4,000. Expense or debits, expense or debits, expense or debits. So it makes sense we would debit wages and salaries and wages expense. Cash is an asset. It increases with debits and decreases with credit. On October 31st, we received $10,000 cash for work that we have done. Cash is an asset. Assets increase with debits, so that part is easy. Expense or debits, expense or debits, expense or debits. The opposite of expenses is revenue. So if expenses are debits, revenue accounts must increase with credits. So this thing here, this service revenue account, keeps track of our revenue, whether we get paid today, tomorrow, or never. That keeps track of our sales, if you will. Please don't confuse that account with cash. This thing right here just keeps track of what we've earned, whether we get paid today, tomorrow, or never. Chapter 3 introduces us to adjusting journal entries. So we want to get our expenses in the right month and our revenue in the right month. So we have to make some adjustments at month end. These adjustments don't involve cash, but they do involve one income statement account and one balance sheet account. So we look in our supply closet and we discover that there's only $1,000 worth of supplies left. We started out with $2,500. There's only $1,000 left. So during the month of October, we must have used $1,500 of supplies. So we have to book that supplies expense. Expenses or debits, expense or debits, expense or debits. And where did those supplies come from? They came from our supply closet. So we're going to reduce that asset account by $1,500. And if we want to, we can show the calculation down here in the memo section. We started out with $2,500. When we looked in there at month end, there was only $1,000 left, so we must have used $1,500. Notice that cash is not debited or credited, but we do debit one income statement account and one balance sheet account. Also, on October 31st, Pioneer remembers that it paid a whole year's worth of insurance at the beginning of the month. So it has used up 1 month of that. So we're going to have to book 1/12 of $600 as insurance expense and reduce our prepaid insurance by that amount of money. This is just like the supplies. We have this asset called prepaid insurance that we've used up. Assets increase with debits and they decrease with credits. Expense or debits, expense or debits, expense or debits. And so we debit insurance expense for $50, credit prepaid insurance for $50, and make our little note down here to explain to the next person how we came up with that number. And this company books depreciation expense every month. I strongly suggest you memorize the journal entry is debit depreciation expense, credit accumulated depreciation. Memorize that now and you'll never have to think about it again. So our book tells us that depreciation expense for the month is $40. Debit depreciation expense for $40, credit accumulated depreciation for $40. Accumulated depreciation is a contra asset account. It hangs out with the assets, it parties with the assets, but it has a credit balance. And then we make our note down here. Russ told me to memorize debit depreciation expense, credit accumulated depreciation. Then we look at our books and we discover that we did $400 worth of work for Mr. Knox. Remember, he paid us $1,200 in advance. So now we get to recognize that we earned $400 of that $1,200. So we're going to reduce our liability account, unearned service revenue, by $400 and get to book that service revenue. If expenses are debits, the opposite of expenses is revenue. And so we'll get to book that now as a credit. Remember, this service revenue account keeps track of our fees earned, whether we get paid today, tomorrow, or never. And these are $400 worth of fees that we earned. Now let's accrue for some revenue that we've earned but we haven't yet booked. When we send out invoices to customers, those are called accounts receivable. So we look at our books, we discover that we have $200 that we have earned but have not yet billed, so we send out the bill. We debit accounts receivable for $200. That's an asset. Assets increase with debits. And we credit service revenue. If expenses are debits, expenses are debits, expenses are debits, the opposite of expenses must be revenue, so we must credit that. Two more adjusting journal entries. We have to accrue for interest expense on the note payable. We've had the use of that money for a month, so we owe them 1 month worth of interest. We want to get that expense, interest expense, into October, so we debit interest expense for $50. That's $5,000 principal times 12%. That's the annual rate divided by 12 because we only want to book 1 month worth of interest expense at this stage. And we have $50 debit to interest expense, $50 credit to interest payable. Interest payable is a liability account, so it increases with credits. And finally, we get to the end of the month and we owe our employees $1,200 worth of salaries and wages, but payday isn't until the next month. If we wait until next month to book that wages expense, it'll look like it was in November. But we've got the benefit of their work during October. So as of October 31st, we make an adjusting journal entry and we debit salaries and wages expense. Expenses are debits, expenses are debits, expenses are debits. And we credit salaries and wages payable for $1,200. This allows us to accrue for October salaries and wages to be paid on the next payday, which will be November 9th. And that's all there is to the adjusting journal entries from Chapter 3 and the original journal entries given to you in Chapter 2. Hope this helps. Hope it's less boring than the book.